In the next 9 minutes, I'm going to teach you every ICT concept that you need in order to become a profitable trader. I wasted years trying so hard to make ICT work, but everything changed whenever I put together a simple and effective list of all ICT concepts. And this is why I'm able to get consistent profits like this, and this. So if you're the kind of person who doesn't just want information, but you want implementation, well then you're in the right place. Now let's dive into the first concept. Today I'm going to teach you everything from liquidity, market structure, market maker models, the power of three, how to put it all together into a profitable strategy, and which timeframes to use. First on our list is liquidity, which is the foundation of all ICT concepts. You need to understand that price is always moving towards liquidity because this is where the most stop losses are, and the larger market participants are going to manipulate retail traders. That way they can take their stop losses and enter positions. There are two key types of liquidity. We have external, which is at swing highs, and we have internal, which is at fair value gaps. If you don't know what a fair value gap is, it's just when we have a big candle, which creates a gap between the candle after its wick right here and the candle before its wick. This area is a fair value gap. Always remember that price moves like a magnet from one liquidity pool to the next. So it goes from IRL to ERL. Once price has moved from a fair value gap to a swing point, if we create a new fair value gap, you expect the market to trade back into it. And once it does, we expect it to trade back to the next swing point. This is because markets are always moving from one point of liquidity to the next. As you can see, the market moves up to this high, and this pattern will continue because this is how the markets work. Liquidity is powerful, but understanding it is just the first step. In order to trade and execute using it, you need market structure. If you could spot a signal that tells you when the trend is over or when it's likely to continue, would that change the way that you trade? Simply put, market structure is just a series of highs and lows, but not all highs and lows are created equal. So we have to use a tool called manipulation and displacement to tell which we want to pay attention to. Now, first, I want you to take note of what classifies as a high or a low. In this example, I want you to pay attention anything that has a higher low on either side of it, meaning we have a 3-candle formation. This candle is the lowest low. We have higher lows on either side. That is considered a low. And then anything that has a lower high on either side of it, well, that candle is considered a high. Now, what happens at highs and lows tells you everything that you need to know. So pay attention right here. What is happening to this low and this low? Notice we're not closing below it. Now, some people would say this is a break in structure, but they'd be wrong. Because when the market doesn't displace or push energetically through a point of structure, it's likely to reverse. Now, this becomes even higher probability with a market structure shift. All a market structure shift is if we go from making lower highs and lower lows to making a true new higher high. Now, what makes it a true and valid higher high? Well, we created a fair value gap and closed beyond this point of structure. You can use this with liquidity or key level taps, which we'll get to later in the video. Now, another trick that you can use with this is anytime that a low